Now, over on page 100, they start walking through different examples of these types of accruals. And you're going to need to know how to record the journal entries for these. So what I'm going to do is I'm going to walk through them, but I'm going to use the T accounts because I find analyzing accounts with T accounts works pretty well. It makes it easier for me to be able to understand what the account is and what it should be. Keep in mind that if we don't record these, we're going to have our financial statements off balance. The income statement and the balance sheet are going to be incorrect. So you're going to need to know the effect of those as well. So let's just take a look over on the prepaid expenses. And on page 100, the first example they have are supplies. And that's a pretty common one. Supplies, you buy in advance and then you use them up, but nobody keeps track of them when you're going through and actually using them up. So what we're going to do is we're going to go through and record the transaction that's shown here. So let me do supplies first. So let's do the T account so we can see the transactions and how they occurred. So this is supplies, it's the asset account. And they tell you that on October the 5th you went through and you purchased $2,500. So you went to Staples, you bought a bunch of stuff, you put it in the cabinet, and then all during the year or during the month people are going through and they're taking stuff out. They're using toner, they're using paper. You don't keep track of that because you don't want to have a journal entry every time somebody goes to get an eraser. So what you do though at the end of the month, October 31st, is you go and you count what's in the cabinet and you realize there's only $1,000 worth of supplies left. Well, what you need to do then is to record what's been used up during the month of October. And so we're going to have an adjusting journal entry for the difference. If we started with the 25 and we want to go down to a debit of 1,000, we have to decrease supplies. You decrease an asset by doing a credit, and the difference is the $1,500. Okay? And the journal entry that would look like that would be to supplies, expense, because we need to record the expense for $1,500, the debit, the credit, and then of course the supplies asset is reduced by the $1,500. So that will be our adjusting journal entry at the end of the month. We've used it up, but it's not going to get recorded because there were no transactions that showed that happening during the month of October. If we didn't do this, our expenses would be understated and our assets would be overstated. Okay, so those are supplies. And again, using the T account, finding out what you started with, where you ended, and seeing what you need to adjust, for me, that makes it easier. They also give on page 101 the example of prepaid insurance. So it's another example where it's a deferral. You've paid the money in first, and now you're going to use it up later. So in the prepaid insurance, what happened was on October the 4th, you went through and you paid $600 worth of insurance, just like most of us do. We pay our insurance in advance for our cars. Then they go through and they say, well, we know that that was for, looks like that was for 12 months. So we know that over time we use that up. But again, there's no cash going out at the end of the month to show what happened. So we've got to show that we've used up some of that. Well, if we have $600 for the whole year and we're going to use it up over 12 months, that works out to be $50 a month. So we need to do an AJE, adjusting journal entry, of $50 in order to show that that expense is going to be recorded. So again, this is an asset account, has a normal debit balance, so we're going to reduce it by doing a credit. And then that leaves us with $550 of prepaid insurance that's still going to be used in the future. The journal entry for this would be to go through and to record the insurance expense, because we've used up some of the insurance for $50, and then to show the reduction in the prepaid insurance asset account for $50. If we didn't do this adjusting journal entry at the end of the month, the insurance expense would be understated, which means income would be too high because we wouldn't have enough expenses, and our assets would be overstated. On 102, they talk about depreciation. Depreciation is kind of a different situation, and we're actually going to talk more about that when we get to the chapter on long-term assets. But what we're talking about there with depreciation is that we have long-term assets like plant, equipment, vehicles, things that we purchase up front, but then we are going to use up over a period of time. They decline in value as we use them, and we have to match that decline in value, that cost of using the item over the period. We don't want to just show all the expense and the time we bought it. So what we do is we actually go through and we spread it out using different methods. that spreading it out is called depreciation. We're adjusting the value down to what we think the usage, the cost of the usage has been. We don't reduce the depreciation or reduce the asset though, because we want to show it for disclosure purposes on the financial statements at its historical cost. So what we do is we use another account called accumulated depreciation, which is a contour or offset account to the asset. So what happens there, you can see they have an example on page 103, example 3.7, where they go through and they show us that we have figured out that the amount of the depreciation we need to record is $40. And we did that by going through and looking at the time period we're going to use the asset and spreading it out evenly over that period. And we'll talk about those depreciation methods in a later chapter. But just to show you the journal entry for that, in this particular case, let's do the expense side. So we have depreciation expense. And at the end of the month, we haven't recorded anything because no cash was being used, so there was no regular entry that was made during the month. But we know that we need to show the expense, and it looks like that was $40. So what we're going to do is we need to do an adjusting journal entry for $40 to show that there is a debit to the expense account. And the entry that we're going to do is going to be depreciation expense for 40 to show the expense, and then we're going to put it into the accumulated depreciation account, which is going to be used then on the balance sheet to subtract from the regular equipment or whatever the item is we're depreciating. And so that's credited. So we're increasing an expense, and then we're decreasing an asset by putting it into the contra account. And again, if we didn't do this entry, we would have expenses too low, which means income would be too high, and our assets would be too high because we wouldn't show the reduction in the value of that asset.